Good afternoon from Shreveport, Louisiana, for the first 2023 edition of the Jack and Bill Show, January 13th.
I have to correct you. It is not afternoon. This is a recording.
Oh, thank you. Yes.
So we are not live today because both of us have things that we need to take care of this afternoon. So we're in at 5 o'clock, bright and early, with our coffee. No, we're not here at 5 o'clock. But we are recording.
William is visiting some friends, and I have work to do with a client at 2 o'clock this afternoon. But we thought we would talk about it's a refreshing start to the year so far, William. It depends upon how you look at it, because I would say 2022, it's nice to have that behind us, because it was the worst year on record for the bond market. It was the worst year on record for 60-40. It was a bad year for stocks. S&P 500 down about 19%. The NASDAQ market down 30, call it 30. Growth stocks down about the same. And then really the only place to hide was in energy and commodities and things like that. So,
and I just want to say, for those who don't know what we mean when we say 60-40, that is an asset allocation, 60% stocks, 40% bonds. It's been overused, I would argue, as kind of a rule of thumb asset allocation by a lot of practitioners. And it has been kind of boilerplated. And the appeal is that by including bonds in a stock portfolio, you are reducing portfolio volatility. But it didn't work last year, as we've discussed previously, because the bond market did not provide ballast when stocks sold off last year.
You could actually flip that around and say that if you have a bond portfolio and add stocks to it, you actually can reduce the riskiness of the portfolio to a point. So I said this was both bad and good. We here at Eagle Financial, trying to say this with humility, we had one of our best years on record on a relative basis, because we made a rotation in early January and before last year out of growthy, expensive, high PE type names and into things that generate a lot of free cash flow and sell at low valuations based upon industry norm accounting based metrics like PE, price to book, free cash flow to enterprise value. Those things rocked last year. So,
and we have to also mention, because we pounded the table on this for years, the importance of having truly non-correlated investments, alternatives. And that's what really helped us last year, because stocks and bonds both sold off. But by having alternatives in the mix, our portfolios fared on a relative basis very well.
Yes. And yes, we owned algorithm run funds in the commodity space that were all up double digits. We had a BDC, business development company. Those are a portfolio of adjustable rate, like bank style type loans. We had one of those taken out, and we have another one in process of being taken out. And so those actually made us money last year. In a bad year for BDCs, we own some BDCs, another one that we own as well, that actually made us some pretty good money. So, and then energy, energy MLPs, we have one that we think should be in just about every portfolio. So that brings us to, we have that behind us. It's the 13th of January already. So we've got, coming into a 3-day weekend, we've got the S&P 500 up year to date through yesterday, 3.8%. And interestingly, the bond market has rallied as well. I look at the very popular Dodge and Cox Income Fund, Bill. This was a huge anomaly. So they have, I think, the 1,000 largest mutual funds make the Wall Street Journal cut for print every day. And Dodge and Cox has a balanced fund, an income fund, a domestic stock fund, and an international stock fund. And last year, their conservative bond fund did worse than all their other funds. You know, that kind of shows the kind of market that we went through. So there weren't very many places to hide outside of alternatives. So Dodge and Cox Income is up 3.4% year to date. That's on a horrific, tear of a pace, given that we're only halfway through.
That's in line with the stock market.
Yeah, exactly. It's in line with the stock market. So, but now we've entered into earnings season, just for this quarter, and we had some banks reporting earnings, noteworthy yesterday and today. We've had JP Morgan getting hammered with bad earnings, and Bank of America reporting okay earnings, but they've had to, of note to me, increase their reserves for
loan
losses up to $1 billion. That's a big number, and I think that's because the consumer has reached a place. They've gone through all their stimulus money, and they're getting kind of tapped out with the really bad inflation that we've had, and seemingly coming down, at least temporarily, but still very high by historical standards. So that's, what really put a damper on things last year. And we've kind of said this, a number of times, I felt like we were held hostage by the Fed's very slow reaction to inflation. The inflationary numbers got out of control. Now market pundits are wondering if they've done, too much. And so we've been held hostage by Jerome Powell and his cronies about what is the Federal Reserve, going to do. Are they going to fight inflation, or are they concerned about the economy? What do you think about that, Bill?
It's a conundrum. It's the conundrum of the dual mandate. So the Fed's original mandate was price stability, which means reining in inflation. But then Congress added a second mandate, full employment.
Yeah.
And so sometimes you really can't do both. And that's why a lot of people think that the Fed, because their primary focus is price stability, they will continue fighting inflation by keeping short-term interest rates high to the point that something breaks, meaning that the economy goes into recession. But, we'll see. I mean, they're trying to thread a needle. Maybe they'll succeed, maybe they won't.
That brings up another interesting point, is that I think about 2/3 of the market strategists, economists, whatever you want to call them, think that we're going to enter into a recession this year. So, and one thing that I would say that really benefited our clients and us, our firm last year, was having a contrarian approach. Now, if you're a contrarian, it requires that you're going to make the most money being a contrarian. If you just think about it this way, would you rather buy a house that nobody wants or buy a house that everybody wants? Where are you going to get a better deal? The same is true. Or if people are falling all over themselves to buy something, and you could say crypto or Bitcoin, November of 2021 at 68,000, and it didn't fare well last year. So
it's a good point.
Yeah.
And when I hear or read prognosticators say that like an entire asset class is dead, we've seen this over the years. Years ago, there was a big headline, stocks are dead. And I read someone recently who said bonds are dead. You cannot say that.
Yeah.
or even 60-40 is dead. Well, it didn't work last year. The bond market had a terrible year last year, but no. If you are an investor, not a speculator, then and you have time, you can weather these things. And oftentimes, what we see is those things, either asset classes or sectors or individual names, will reward investors who take a contrarian approach and have patience.
Very good. Very well stated, Bill. So it's interesting. I think we were listening to a Jeffrey Gundlach. He may manage as much bond market money as anybody in the world. I don't know. He's definitely in the top 5
bond guru.
And I have really just about always thought highly of him, because he's made market forecasting that's really proved beneficial. And it was interesting. I felt like maybe 6 months or a year ago he was kind of wandering off the path a little bit, but he made an interesting point yesterday, and I liked a lot of the stuff that he had to say. And that was, the 60-40 that you just elaborated on, Bill. He said, a lot of people were saying 60-40 was dead, and 60-40 was dead just 15 months ago when you had long-dated treasuries yielding less than 2% and short-term treasuries yielding less than that, and everything else in the bond market, trading off of the treasury curve. So we learned our lesson that yields moved up sharply, bond prices got hammered, and so 60-40 is not dead this year, but you have to be careful about the way you institute it. Absolutely. And so the 60-40, if you think about this now, and we pointed that out with the Dodge and Cox Income Fund, as you said, up about the same as the stock market. Well, if you bought a bond, let's say you bought a 10-year bond 15 months ago, and it's trading now at 75 cents on the dollar, and rates come back down, that offers appreciation potential. Sure. That would be not unlike the stock market. So his point was that the new 60-40 is 40-60. So what he's saying is your portfolio should not be 60% in stocks and 40% bonds, but rather 60% in bonds and 40% in equities. Now, he's a bond guy, but the implication is that bonds are likely going to do better than stocks. And he says bonds are way cheaper than stocks. And I happen to agree with that partly. I think only if you're looking at bonds that mature maybe within 3 or 4 years.
For people who like guarantees, I use that term very loosely because we see that, like talking to people who want like annuities, fixed annuities, because there's a guaranteed return. Well, it's guaranteed to the extent that the issuer of the annuity can fulfill its obligations. But that's like a bond, right? A bond or a CD, there is a guaranteed return. Mathematically what your return will be based on what you pay for it, the coupons you collect, interest payments, and then what you get back at maturity. That's guaranteed unless the issuer defaults. And so for people who like guarantees, want to know mathematically what their return will be over a period of time, bonds are terrific. And so to your example, Jack, someone buys a bond at 75 cents. Normally it trades for $1. Well, at maturity, you get that full $1 back, and then you're collecting all those interest payments. That's a great return at these depressed levels. I think that the biggest challenge for investors, retail investors, is that they're not comfortable buying individual bonds. They're not comfortable doing credit analysis. And so they just throw money into bond mutual funds, and they're paying very high expenses, and they have no control over what's being bought within those funds. Well, we have a lot of experience with fixed income or bonds. And we like to do the analysis and dig into a fund or even buy individual bonds. That's where we're adding value.
Yeah, I'd like to throw this out. In our latest market commentary, which is on our website, I pointed out that, we have a significant weighting in a bond fund that's a short-term bond fund. I think it's rated 5 stars.
It is.
Yes, it is, and it now has a gross yield to maturity of over 10%, and these bonds mature inside of 2 years. So, and it's an investment grade portfolio. And in fact, the portfolio manager has been putting cash into Treasury inflation protection securities most recently. So he's.
However, if you're a retail investor and you have an account at one of the large brokerage houses, odds are that you can't even access this fund.
Yeah, that's a very nice point to
through the custodians that we utilize, we have access to much more than what the large brokerage houses offer.
Oh, I'd like to make another couple of points regarding that, because we're not telling you to go from 60-40 to 40-60. The asset allocation equation is dependent upon one's individual goals, risk tolerance, return expectations, time horizons, all that stuff. But it is a time to consider giving a greater weighting, perhaps, to bonds, since there's way more opportunity than there used to be. And I think that in the stock market, the risks could be to the downside still. We don't know. I would not be surprised if the stock market went up 15% this year. I would be surprised if it went up more than that. And but the other thing about the 60-40 is we kind of moved away to like 60-20-20. We weren't really allocating to fixed income that was paying us 1%.
No.
That's how we ventured into the alternative space. So you were going to make another.
Oh, I was just going to say, what you're describing, Jack, is what we call in this office a tactical adjustment. So
Yeah.
Our client, in working with a client, we will come up with a strategic or long-term asset allocation that's best for that individual client. But then there are times like today when it makes sense to make a tactical adjustment, adjusting that asset allocation to take into account current market conditions. Why just have a static portfolio? We do need to think about what's going on now and what we expect will happen in the near-term future and adjust accordingly.
That's a very good point. And then I might add to that, here's the part that I didn't really agree with Jeffrey Gundlach on, and that is I think some of the most mispriced securities are long-dated bonds, because historically, dating back to 1926, an investor gets typically 2.3% in yield more than where the CPI inflation rate has been historically. So we came in, we got all the way up to 10% last year. We've come down, I think, 5 months in a row now, with the CPI number coming out yesterday, right on the screws where the forecasts were at 6.5%. So if you apply that logic and math to that, that means that 10-year treasuries or long-dated bonds should be yielding 6.5 plus 2.3. That's 8.8% or more.
That's Jeffrey texting you. He's saying it's not that simple, Jack, but that's okay.
Well, you could say, well, the market is a discounting mechanism, and it could be discounting something very different than high inflation. But Bill, we've had very high CPI inflation now for over 2 years, and bond yields never got up there, even though bond yields did rise hugely on a percentage basis last year. I just think that we could have inflationary problems that are long dated, and we're just going to say that we don't know. We don't try to forecast that, and therefore,
long run, yes. I mean, we have
That's right.
structural issues that present the long-term inflationary risks, like an aging population. That's a demographic risk that is inflationary. We also have the issue of these ballooning budget deficits, debt ceilings, and all of that is inflationary long term. And then geopolitical issues, like look at what's going on between Russia and China and Iran. All of that has long term inflationary risks. I think we can agree that in the near term we are seeing inflation come down. Some of that is base effects, meaning that it's a year over year calculation, and so mathematically that number, the CPI number, will come down on its own just from base effects. But we are seeing improving numbers. I don't think any reasonable person thinks that we'll be able to maintain the Fed's 2% inflation target long term, though.
yes, and we agree with that. So the main point or application that we can take from that revelation is that we want to avoid long-term bonds because they're just as risky as the stock market.
Oh, yeah.
So with that, what do we do differently this year? What do we do with existing portfolios? Bill, you want to take a stab at that?
I'll say this, for our client portfolios and probably for most of our audience, the one word I would offer is rest. Mm-hmm. We saw everything get beaten up last year, and there's a tendency when you see a lot of market fluctuation to overreact, overtrade. And sometimes the best thing is just step back, take a deep breath, and rest, because these asset prices will eventually recover, and we are starting to see recovery. So if you're very comfortable, with how you're currently positioned, just rest, let the process work its way out. But there's, look for opportunities to make some adjustments as needed.
Yeah, let me give an example of that,
Mm-hmm.
Bill. Our largest equity holding is an ETF that every quarter it rotates 100 stocks from the Russell 1000, which is 1,000 blue chip companies, and it's based on the metric of free cash flow to enterprise value. So these are low multiple stocks that generate huge cash flow. These are highly performing, high quality companies generating free cash. That strategy in 2021 earned 43%. In other words, that ETF earned 43%. And last year, on a total return basis, it actually made money in a market that lost money. And this year, it's leading the pack again. I mean, pretty much. It's up over 5% this year, with the S&P up 3.8. And I might, just to show you how these are things that we like. I noticed we own a miners ETF that's up 12.4% this year. We love certain cyclical stocks. Just to throw this out there, Ford and General Motors are up. Ford's up 9% this year, just this year in 13 days. Delta Airlines is up 15%. Delta is a very well-run airline that is selling at a PE of 4 times next year's earnings. So I don't think it stays that way. So bonds have made a sharp move. Crypto's made a huge move up so far this year. Gold is up over 5% and is this morning breaching the $1,900 an ounce level. These are things that we think you should have some exposure to. Okay, I mean, like the miners.
I think what you're describing is what's often referred to as a barbell approach.
Yeah.
So having having an overweighting to quality, but also having some more speculative things if you can weather that. This rally that we're seeing thus far in 2023, the biggest gainers are more speculative.
Yeah, like you could say, like I think Amazon is up 13%. Well, Amazon lost roughly 50% last year. If you're looking at quality names like an Amazon that was down more than 50% this year, I mean, you're probably on to something. So, I mean, we as a firm still feel like the trend is your friend. That was my point with the free cash flow ETF that's done so well. It's still doing very well, and I wouldn't be quick to trade out of that and go back into growth names. This could be a multi-year phenomenon.
Well, the other aspect of that is that if the economy is pushed into recession because of the Fed's tightening policy, wouldn't you want to own quality names that are generating lots of cash?
Absolutely. So for that reason, we're staying in that. And and it's interesting to note, just looking at the Treasury yield curve this morning, a 2-year Treasury note yields 4.24. Now, it had gotten significantly higher than that. And yesterday, it was flirting with the 4% level, but the 30 years is 3.6%. So that's inverted. So the 10 year is 3.44%. Significant 3/4 of a point or 0.8% lower than the 2-year note. We really don't find value in that. That's a danger zone. So we'll see. I would, in conclusion, I'd like to say that we welcome a phone call. It's a great time to be rebalancing portfolios. If you have a portfolio that got hammered last year and you don't know what to do with it, give us a phone call or an email. Come see us, and we should sit down and make sure that your assets are positioned in accordance with and on track with your long-term goals and objectives. And with that, we've got to talk. We've got to talk sports for just a minute, because we've got a 3-day weekend coming into Martin Luther King Day on Monday. There's actually NFL games Saturday, Sunday, and concluding Monday night with Tampa Bay, Dallas visiting Tampa Bay, and the GOAT, Tom Brady. But before we talk about that, we've just got to say, we live in the South. We're SEC fans all the way. We think that the whoever the college football selection committee for the playoffs, we think they had a huge blunder this year, picking 2 Big Ten teams, one SEC team, Georgia, who won the whole thing, and then TCU was ranked 3rd. Got beat in their conference playoff and stayed at 3rd. And you could say 5th ranked Alabama got slided, and 6th ranked Tennessee got slided, and they annihilated their bowl game opponents. So, and the Big Ten, Bill,
let me just say,
both of the Big Ten teams lost. Okay?
I totally understand the controversy over the inclusion of TCU. But all Alabama had to do was win, and they had 2 losses. Now, would Alabama have fared better than TCU in the playoffs? Absolutely. Absolutely.
That's what was proven, and I think they've got one more year to try to get this right, and then they're moving to a system next year of 12 teams in the playoffs, and that's going to allow the cream to rise to the top. But
and
TCU,
generate more money.
Exactly. TCU had an embarrassing loss, 65-7. Georgia could have. They scored on their first 7 possessions. There were TCU players on the sidelines after the game admitting that there was a higher level that they had not attained to. So, but here we go. We've got the NFL this weekend, and of local note, We've got Peterson, who coached at Calvary, Doug Peterson, won a Super Bowl, did very well with Calvary here in Shreveport, 2A school, and climbed the ladder most expeditiously, won a Super Bowl at Philadelphia, got in a quarterback controversy and got fired after one crappy season. You know, Bill, that the NFL stands for not for long if you're not producing. You know, what have you done for me lately?
Yep.
So Peterson goes to Jacksonville, has the new star quarterback that played at Clemson, the flowing hair guy. What's his name? I forgot. I'm sorry. Anyway,
I don't identify with people with long hair.
Jacksonville. I would love to see him do well. Jacksonville is playing the Chargers. We've got our LSU quarterback at Cincinnati playing Baltimore. Baltimore's quarterback is still out. He's not going to make it. Knee problems. And then we've got Damar Hamlin's team, Buffalo. That's going to be the sentimental favorite to win the whole thing. And they're playing Miami. And another interesting side story on that is Tua is not going to take the field because he's had at least 3 concussions this year. So it looks to me like Miami's going to be exiting along with Baltimore. And I'd like to see Doug Peterson and the Jaguars do very well. On the other side, I'm going to call an upset. Look for the New York Giants to upset Minnesota. San Francisco has a powerful defense. They're playing Seattle. They're gonna win that one. And then Monday night, we've got Dallas invading Tampa Bay. Local Dak Prescott from Houghton High School has never beaten. The Cowboys have never beaten Tom Brady. Dak's never beaten Tom Brady. The Cowboys have lost 8 playoff games in a row on the road. They're going to be favored in this game, but the GOAT, the greatest of all time, Tom Brady, proved that he likes football more than being married. I think he's all about serious business Monday night, and I'm picking Tampa Bay. So, if you, what else, William?
I have nothing to add.
Okay. Thank you for watching the show. If we can help you with anything, please give us a ring, and a belated Happy New Year to all. Be safe this 3-day weekend.